we calmly organize the movements of the world and the flow of the markets. This is Moonvale Atelier's economic analysis. Today I want to start with a simple claim. The biggest thing markets still underestimate is not the war itself. It is what happens when governments can no longer afford to act according to their own stated principles. If Hormuz remains constrained, and Red Sea disruption hardens at the same time, the real story is not just about missiles, tankers, or oil headlines. It is about a world shifting from rules to exceptions, from clean sanctions to selective waivers, from climate discipline to fuel survival, from liquidity promises to gates, caps, and pro rata exits. And for the United States, that raises the most uncomfortable question of all. What exactly does Washington protect first when it cannot protect everything at once? Gasoline prices? Sanctions credibility? Alliance trust? Treasury market stability? Private credit liquidity? My core argument is this. If this turns into a prolonged double choke point crisis, America is more likely to preserve domestic stability than policy consistency. And markets are still not fully priced for that. Chapter 1. What markets still underestimate. Too many investors are still treating this as a headline war shock. But the more dangerous version is a systems shock. Hormuz on its own is already a supply choke point. Add a harder Red Sea disruption, and the problem becomes much bigger than missing barrels. It becomes a capacity crisis. Distance rises. Insurance rises. Shipping times stretch. Effective delivery capacity shrinks. That means supply can exist on paper while becoming less useful in practice. Oil is produced, but arrives late. Gas is available, but not reliably deliverable. Refined products are technically there, but not where they are needed. That is the first underpriced risk, a quantity shock turning into a logistics and capacity shock. The second underpriced risk is fragmentation. Long crises do not create cleaner coordination. They create exceptions, side deals, selective enforcement, and quiet carve-outs. The third underpriced risk is liquidity illusion. Investors are comfortable with semi-liquid credit structures until they discover that liquidity was conditional all along. When redemption caps and gates become repeated headlines, the issue is no longer valuation. It becomes trust. Chapter 2. Who breaks first? The first entities to bend are not always the military actors. Often they are the import-dependent economies with the least room for error. Japan and South Korea matter because oil reserves buy some time, but LNG and power stability are much less forgiving. If gas inventories become the immediate constraint, then climate discipline, market purity, and policy consistency all move down the priority list. That is when coal restrictions get loosened. Nuclear restart debates intensify. Demand restraint becomes politically unavoidable. The key insight here is psychological as much as economic. People expect dramatic collapse, but what actually changes policy is the fear of everyday disruption. Electricity reliability, heating, industrial continuity, consumer anxiety. That is why the first break in principle often happens far from the front line. Chapter 3. What America is most likely to betray. For a U.S. audience, this is the heart of the matter. If this drags on, I do not think Washington abandons power first. I think it abandons consistency first. That means sanctions consistency, alliance messaging, the idea that rules are applied cleanly and predictably. Why? Because gasoline is political. Inflation is political. Consumer sentiment is political. Credit stress is political. A neat sanctions regime is sustainable only as long as the domestic cost remains tolerable. But once inflation, market stress, and energy availability start colliding, exceptions become much more likely. And that is already the dangerous shift. Markets do not panic when doctrine officially changes. They panic when they realize doctrine had already changed in practice. If Washington starts protecting supply first and narrative second, investors will have to reprice much more than crude. They will have to reprice alliance credibility, European trust, sanctions discipline, and even the durability of America's policy premium. Chapter 4. From energy stress to credit stress. So when do markets really panic? Not necessarily at the first oil spike. The deeper sequence is slower and more dangerous. First, oil rises, equities weaken, the dollar firms, and inflation expectations tick up. That is still a recognizable pattern. Second, shipping friction persists. Insurance costs climb. Delivery windows become uncertain. Companies start realizing the difference between expensive supply and unreliable supply. Third, credit starts to crack. Redemption caps normalize. Semi-liquid funds face pressure. Refinancing gets harder. Loan spreads widen. High yield starts to reflect not only weak growth, but weak liquidity confidence. That is the turning point. Because once investors stop trusting exit mechanics, the crisis is no longer just about energy. It becomes a market structure problem. And when market structure becomes the problem, old relationships between assets begin to wobble. Gold can rise and then be sold for liquidity. Treasuries can catch a bid and then face inflation pressure. The dollar can rally on fear and then confront questions about U.S. policy credibility. That is the underpriced regime shift. Chapter 5. What happens in 1, 3, and 6 months? In 1 month, the most visible changes are likely to be tactical exceptions. More rerouting, more emergency releases, more quiet diplomacy around cargo priority, transit, and waivers. In 3 months, the strain becomes harder to hide. Corporate margins weaken. Insurance and transport costs feed through. Subsidies become politically expensive. Credit markets start looking less stable and more performatively stable. In 6 months, the issue is no longer cost. It is regime change in assumptions. Assumptions about sanctions discipline. Assumptions about climate timelines. Assumptions about central bank room to maneuver. Assumptions about liquidity. Assumptions about America's ability to enforce external discipline without internal compromise. That is when investors may stop asking whether this crisis is temporary and start asking whether the rules of the pre-crisis world still apply at all. Closing. So let me end with the question I think matters most. If the double choke point scenario hardens, who abandons their preferred fiction first? Who drops climate purity for power stability? Who drops sanctions consistency for supply? Who drops liquidity promises for gates and caps? Who drops alliance discipline for domestic survival? For the United States, that is the central contradiction. America wants to project strength abroad without losing stability at home. But a long energy and logistics shock makes those goals harder to reconcile. And once credibility starts bending, markets do not just reprice oil. They reprice the assumptions underneath everything else. If you found this useful, tell me in the comments, which principle breaks first? Sanctions consistency, liquidity confidence, alliance trust, or climate discipline? Thanks for watching.